Ladies and gentlemen, good day and welcome to the Jindal Steel and Power 3Q FY23 earnings conference call hosted by Antique Stock Broking. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pallav Agarwal from Antique Stock Broking. Thank you and over to you.
Yeah, thank you, Yashasri, and good evening, everyone. A warm welcome to the third quarter results call of Jindal Steel and Power. We are joined today by the senior management team from JSP, Mr. Vimlendra Jha, the MD, Mr. Ramkumar Ramaswamy, the CFO, and Mr. Vishal Chandak, the Head of Investor Relations. So I would like to now hand over the call to Vishal for his opening comments. Yeah, Vishal, over to you.
Thank you, Pallav. Ladies and gentlemen, good evening and thank you very much for joining us for the Q3 briefing of the earnings highlights for JSPL. So we will start with a quick overview on the financials by our CFO, Sir Mr. Ramaswamy, and then we'll jump into the Q&A. So without much ado, sir, I'll hand over to you, sir.
Thank you. Good evening and good day, everyone. Let me give a quick overview of the financial and operational performance for this quarter. Let me start with the sales volume first. Our volumes for the quarter was 1.9 million tons. This is a 6% decline QOQ, primarily driven by a 48% decline in exports. The domestic volume also marginally declined by 1%, primarily driven by issues around rake availability and dispatches. The share of exports in the total volumes declined to 5% as against 11% of the previous quarter. The production for the quarter was 2.06 million tons, which is a 13% increase quarter on quarter. As you would know, in the last quarter we had some shutdown, and this quarter all the plants produced at optimum capacity. The Angul plant created a world record in production during the quarter by producing 54 heats in a day during October. Let me talk about realization. Our NSR declined by 1% quarter on quarter as the pricing remained soft during the quarter. And to give you a quick sense of where we are, currently we are seeing prices firming up and the current realizations are marginally inching up by 1 to 2%. Our SMS cost declined by 9% during the quarter. This was primarily driven by a lower coking coal price of around 18%, lower thermal coal prices of around 17%. Iron ore prices remained flat during the quarter. As per our practice, we do not provide any forward guidance on numbers for the subsequent quarter, so I'm not giving those guidances. Let me move on to EBITDA. Our standalone adjusted EBITDA is rupees 2,163 crores. This is 52% higher quarter on quarter, primarily driven by the factors that I detailed earlier. That is lower volumes, lower realization, offset by lower costs. The EBITDA for the EBITDA per metric ton for the quarter improved and is rupees 11,180 per metric ton. The consolidated EBITDA for the quarter is rupees 2,296 crores, which is also 51% higher QOQ. The main operating entities, Mozambique, South Africa, and Australia, they had an operating EBITDA of around $20 million, and after adjusting for FX, this translates to a $4 million during the quarter. Profit after tax, on a consolidated basis, our profit after tax was 518 crores, which is 137% higher quarter on quarter. Before exceptional items, our profit after tax is rupees 897 crores for the consolidated entity. I would also like to give an update on the overseas subsidiaries investments that we had highlighted last quarter. As highlighted earlier, we have concluded an independent valuation exercise, and based on that, we have provided for rupees 7,253 crores in the standalone entity against the overseas investments. At a consolidated level, this provision gets offset. We have, however, charged off goodwill and other assets appearing in the consolidated books to the tune of rupees 378 crores, which you will see in the financials as one-off exceptional items. Based on the above provision, our net loss at a standalone entity level is rupees 4,512 crores. Exceeding the one-offs, our profit after tax is rupees 836 crores during the quarter for the standalone entity. I'll give a quick overview on our debt. Our journey of deleveraging continues. Our gross debt at the end of the quarter was rupees 10,983 crores and net debt was rupees 7,478 crores. At a consolidated level, our net debt was rupees 7,090 crores, which is 0.66 times our EBITDA. I'll also give a quick overview of our cash flow and then we can open up for Q&A. We had an opening balance of 6,383 crores of cash. Our adjusted EBITDA was 2,161 crores. We had a net reduction in working capital of 713 crores. This was again our focus on cash and inventory reduction. We had also taken short-term loans of around 410 crores for the power assets that were acquired. These were the main inflows. In terms of outflows, we concluded a refinancing of a loan to the extent of 1,728 crores. We repaid short-term buyer's credit and working capital loans of 968 crores. We invested in our subsidiary Jindal Steel Orissa 939 crores. Our advance tax payment was 710 crores. Our own capex, both sustaining and growth capex in JSP was 642 crores. Scheduled loan repayments was 448 crores. And the financing cost was 343 crores. With this, we ended with a net balance of 3,505 crores. Again, to summarize, cash flow from operations was 2,164 crores. Cash flow from financing was negative 3,077 crores because of the various repayments that we did. And cash flow from investing was 1,965 crores, resulting in a closing cash of 3,505 crores. With this, I would like to conclude the overview and hand over for any Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Amit Dixit from ICICI Securities. Please go ahead.
Yeah, good evening, everyone. Thanks, sir, for taking my question and congratulations for a good set of numbers. I have two questions. The first one is essentially on sales volume, which was a tad lower in this quarter due to rake unavailability and issues around dispatches. So my question is there some volume lying at the port or at the plant that we can expect will come in Q4? And if you can also guide for the sales volume for the full year or for Q4 as you deem fit.
Yeah, this is Bimlendra Jha. Thanks for your question. There was not much of a FG inventory built up. It was only about 35,000 tons that was built up. So we, as you know, one of the reasons why we had much higher sales number at end of quarter 2 was because there was a lot of inventory lying with us, and we wiped the slate almost clean at the end of September. So thereafter, it has mostly been whatever we have been able to produce is what has been sold, except for some rake unavailability issues due to focus on coal movement in India. So that focus from the government has not changed, and therefore we continue to face some difficulties on the movement of our raw materials as well as finished goods. So barring that, we don't see any issues, and whatever we produce, we should be able to sell. on that rake movement also, we have tried to compensate it as much as possible through the road, and we are also buying our own wagons. So, but that is also, as you may be aware, is taking time in India to get your wagons very quickly because there is shortage of wheels in India. So these are some of the challenges that the Indian industry is facing. And other than that, whatever we produce, we'll sell. So that is the only guidance we can give you.
Okay, fair enough. So coming to overseas mining subsidiaries, I mean, we have seen that so far in terms of volumes, they have been pretty staid. So going ahead, what kind of volume growth we can see over there, particularly from your Australian mining subsidiary?
So in Australian mining subsidiary, we have been, trying to debottleneck that and make some solid adjustments to the way they mine and process the coal. And that should be still after June, we are expecting that they'll be in a position to have a proper mining and coal beneficiation and also get better gains from that. Because it is at the end of the day, it is all coking coal, and because of the high ash content, it gets sold as a thermal coal. So all that will change after they have invested in that washery, etc., that they're doing.
And what would be the quantum of that investment, that washery investment?
It's minor, I think. How much?
I think we are evaluating the capex investments in Australia. And maybe by next quarter, we will be able to provide a clearer view. Yeah? At this time, it is a bit early. But it is not substantial. It's not substantial. It's small amount.
Okay, sure, sir. Thank you, and all the best.
Thank you.
Thank you.
Thank you. We have our next question from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Yeah, good evening, and thank you for the opportunity. My first question is, if you could just share the updates on all the growth and cost-saving projects which are lined up as far as their commissioning timeline, specifically for coal blocks, the slurry pipeline, the pellet plant, and the hot strip mill.
Okay, so some of the clearances, etc., are still in the process, and therefore some of these will be only done as those clearances keep coming. But the pellet plant is very close to commissioning based on the earlier clearances that we have had. It is under trial testing phases, so we will be. We will soon get the consent to operate, and we will be able to start operating that plant. Coal mine will be the next big one, and there are again clearances in the process. We have kept everything ready in terms of the equipment, contractors, etc. So the moment we get all the clearances, we'll start moving into the land, and so that's just a matter of time. It can happen in weeks, in months, whatever. Whenever it happens, it is all part of the government process. We start moving in, and within 4 weeks, we start taking it out from the date of clearance. So that's the next one. As far as our slurry pipeline is concerned, that's a slightly longer project. We have completed nearly half of it, and half of it is the more tougher areas where things are moving a bit slower compared to our expectation. But that is where all the conversations are happening to facilitate that. So as far as hot strip mill and the rest of the investment around that is concerned, that is proceeding on a sound basis, and Q2 of next year, we should be able to see these investments coming up.
Okay, got it. So with respect to the coal mines, all the 4 coal blocks, I mean, they are seeing delays because of regulatory issues, or we are seeing some progress in 1 or 2 of them? Any details, mine-wise, if you could share?
No, we are seeing progress. It is just that the progress is not to our taste. But it is, maybe we would want things to happen in a week, which might be taking 4 weeks. So that's the difference of expectation.
Okay. And sir, with respect to the blast furnace and the hot strip mill, that is expected to, commission in the second half of next year and start contributing volumes?
Not blast furnace. We need clearances, etc. It is the hot strip mill which has got off everything. So that will definitely be commissioned in the second quarter of next financial year. And apart from that, we have got our just 1 second. I'll give you the timelines from. So second quarter of FY24 hot strip mill, pellet plant, of course, the first one I've already told you. In the current quarter it should happen. Then slurry pipeline will be, definitely by the second to third quarter of next financial year. And then blast furnace should also come up by the end of third quarter. BOF around the similar time. So this is the kind of a timeline that we are working with.
Understood. So my second question is with respect to the coal cost. Domestic coal availability appears to have improved, and even thermal coal international prices are down. So, what is the sense on coal cost reduction going forward, both on thermal coal and coking coal versus the 3Q level?
Coking coal, the international prices are not down. They are up compared to last quarter, although they are down compared to last year. So if you are making comparison with respect to last year, of course they are down, but then those were exceptional numbers. If you compare it to the previous quarter, then they are up, and that kind of a movement in coking coal prices is anybody's guess, and it is dependent a lot on what happens in China. And China, when it returns after the Chinese New Year break, that is when we will know in which direction the coking coal prices are moving. So that's very clearly also an indicator that of demand. But the world level, the expectation is that the current calendar year is likely to be in China. Overall, the world is expected to increase it by about 17 million tons, out of which 7 million tons growth is coming from India alone, is what is the expectation for the current calendar year. So that means the current quarter and the 3 quarters of next financial year. So in this one, India we see walking to a different drumbeat compared to rest of the world, which might open up a similar kind of a possibility that happened in the past, where the raw material prices, if they don't pick up as much as what happens on the steel demand side, then you can look at robust performance by steel players in India.
Okay, and any outlook on the thermal coal?
On thermal coal, see, we will be, the moment our mines open up, we are completely independent of what happens in the market. And that is why we are very keen that all our clearances happen quickly and we start mining. So,
all right.
Related.
Got it. Thank you and all the best, sir.
Thank you. We have our next question from the line of Siddharth Gadekar from Equirus. Ladies and gentlemen, in order to ensure the management is able to answer queries from all participants, kindly restrict your questions to 2 at a time. Mr. Gadekar?
Hi, sir. Good evening. So first question is on the pellet plant. So given that our one pellet plant is coming online by this year end, so next year, what kind of pellet volumes can we expect from that plant?
So this is a 6 million ton per annum pellet plant.
Correct.
And therefore, and it's not a very steep learning curve or anything for us. It is just a question of commissioning and thereafter quick ramp up. So that's the kind of a capacity it has. The only trials and testing that we will have to do is that whether the quality of DRI pellets we are able to produce, whether we are able to use flux pellets and all. So to that extent, we will be moderating the volumes, but otherwise its capacity is 6 million ton per annum.
So we can expect 4 million ton from that plant in FY24, and that will be entirely external sales, right?
FY24, yeah. No, it will not be external sales. We will be, because it is coming up at Angul, it will be entirely consumed in-house.
Okay, so given we already have 9 million ton of pellet capacity, so from there we will be doing some external sales next year?
So net, you will see a sales from Barbil, where we are getting our current pellets from. So we will, whatever is the quantity of pellets that we produce and consume in Angul, will be the quantity of pellets that will be released from Barbil for sales.
Okay, so got it. So, and secondly, in terms of volume outlook, how should we look at it from fourth quarter and FY24 perspective?
See, volume is stable, and it is something that we are expecting that the demand in this quarter should be good. Export inquiries have also increased. So as long as we can manage the logistics, I said earlier, we will be able to sell everything that we can produce.
Okay, and so for FY24, any volume guidance?
We don't give forward-looking statements, as you are aware. So the guidance is what you can see.
So is it fair to assume that if the industry is going at 6-7%, we will be going at 7-8%?
As soon as I say yes or no to that question, then I'm giving you forward-looking guidance.
Okay, sir. Thank you.
My request is, as we mentioned, we do not give forward-looking guidance either in terms of costs or volumes. So please, if note of that, yeah.
Okay.
Thank you. We have our next question from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hi, my first question is on the 7,000 crore write-off that we have taken in the standalone. So we understand it's to JSPML, but which are the end-use entities where we have actually lent these monies to? And do we plan to invest further in these subsidiaries?
So the end-use subsidiaries are quite many, right? I mean, the main ones are, of course, you have Australia, Mozambique, South Africa. But then we also had, Mauritius had also invested in various other subsidiaries like Bolivia and Botswana and others. So we considered all of these investments when we did a valuation of how much we have invested. And the outcome of that is the impairment provision that we have made. I think you also asked a question on investments. So there is no current plan to invest anything further in any of these subsidiaries. Yeah. As and when there are any plans that are made, we will definitely disclose that to all of you. But at this point, there is no further investment in any of these subsidiaries.
Sure, this is helpful. My second question is on the captive coal blocks. So once these blocks are commissioned, as you mentioned, you will be fully independent on thermal coal. And how does the cost look versus your current landed cost? Is the mining cost and the landed cost of those materially lower or largely in line, including the royalty?
No, it will be materially lower. Our own coal will be materially lower.
Sure. Thank you. That's all from my side.
Thank you.
Thank you. We have our next question from the line of Ritesh Shah from Investec. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So a couple of questions. First is, sir, how should one read into the tax implication of the write-off 7,700 crores? If my memory serves me right, we had some prior gain corresponding to JPL. How should we connect both the dots, sir? That's the first question.
So we have created deferred tax assets to the extent of 1,900 crores in this quarter. As and when we decide to write off, the appropriate tax adjustments would be made. So I think that is how you would like you should be viewing the tax benefits because of this.
Sir, if I could just stretch it, should we assume that whatever gain we had, we have a complete offset in place, so there won't be any tax incidents?
No, I wouldn't suggest you should make that assumption for two reasons. The gain that was there, I'm assuming you're referring to the JPL divestment.
Yes, sir.
Was a capital gain, and the tax impact on account of this write-off would be a revenue related item. And also there is also a question of when we will actually do the write-off. This is currently, only a provision that we have made. We will have maybe 1 or 2 more quarters where we'll again evaluate and firm up our positions, and then we will keep you suitably advised.
Perfect. That's helpful. My second question is on more on capital allocation. So one is I just wanted some color on Monnet Power status, financial impact, and timelines. The second is basically, are we looking at any inorganic moves? What we understand is NMDC steel plant is also there. It could be of interest. That's the second bucket over there. And the third bucket, there was news flow pertaining to JPL, or I think the promoter entity, setting up a power plant in Mozambique. The third point, is it any which is related to the company? So I asked basically 3 buckets on capital allocation. One is Monnet, second is NMDC steel plant, and third is power. Yes, sir, all related to capital.
One question. So I lose track of all 3 questions. But nevertheless, it is the first one is easy because it is in our interest to quickly decarbonize. So our investment in Monnet is about reducing the carbon footprint and getting a lower cost of power. In fact, it will be lowest cost of power probably that we'll get being a pithead plant. So this is something where we want to expedite it, and we are giving ourselves a couple of years for the entire investment to be made. Around 1,500 crores or so is our current estimate of making it good, and it will be done in phases. So this is what is on your first question. The second question and third question, if you want to, the second one was? Inorganic mode, yeah. So we have already been very clear that these are good assets, NMDC or RINL, etc. But there are all the time anyway, our company is on lookout for such good assets, and we will continue to explore this and will continue to remain interested in these. And the third one was around Botswana and JPL, etc. So yes, JPL is doing something over there where we do not have much to say.
Sure, sir. I have follow-up, sir. I'll join back the queue. Thank you so much.
Thank you. We have our next question from the line of Amit Murarka from Axis Capital. Please go ahead.
Yeah, hi, good evening. So my first question was around thermal cost, coal cost. So could you shed some light on how is the DRI cost changed in the quarter, and are you seeing some benefit of the thermal cost reduction?
It has not changed yet because these coal mines have not opened yet. So thermal coal, whatever has been the market prices, etc., that is everything has been sort of in line. But if you see overall, our cost has reduced by about 9% in steel production, and that was thanks to the variety of raw material mix, which included, of course, thermal coal and coking coal and iron ore. So given that trend, we were able to almost keep our NSR, the prices stable, whereas the cost gave us a good advantage, and that is where you are seeing the result of quarter on quarter, 50%, more than 50%, I think 51% on consolidated basis, 52% on standalone basis, EBITDA improvement. So that is a direct result of cost reduction, primarily on account of raw materials.
Sure. Also, given that the regional demand outlook is now better, could you kind of help understand how is the exports outlook for you changing in this situation?
So, see, market outlook, we are seeing a good, robust improvement in the order book, which, as you know, that this export duty was withdrawn only in the month of November 2022, and it was that quarter was already booked out. So inquiries started coming in after that, but that is mostly for the current quarter. And therefore, from a minuscule level to a decent order book, and that is always a question of where we get better realization. So we keep evaluating that, and we keep taking the orders or not taking the orders on that basis. So we are seeing a very good, healthy pipeline of order book.
Right. I mean, basically, last 2 quarters, the exports have been weak. So, like, can we expect it to go back to like usual 20% of the total volume that we have seen in the past?
See, as I said, that the decision on every order is based on the alternatives, and we are not fixated on any export as a percentage. What we are fixated on is highest value for the products that we make. And that is a decision which is based on every inquiry, and in the same time frame, the alternatives that we have domestically. So we would not want to hazard any forward-looking statement on how much would be the percentage of export.
Okay, got it. Thank you. I'll come back in the queue.
Thank you. We have our next question from the line of Kirtan Mehta from BOB Capital Markets. Please go ahead.
Thank you, sir, for giving this opportunity. One question on the coal mining project. You mentioned that some of the clearances are coming in bit late. Could you explain us what are the clearances involved and what are the steps involved in achieving these clearances?
I'll have to write a book and give it to you on the number of steps involved, unfortunately. It's just too many. It's just too many. But every step has to be, patiently answered, replied for, and we keep going on and on with every step. And then I can't give you the whole list of at least 20 or 30 steps which we are monitoring on a daily basis.
So broadly, if we have to revise our plan, accounting for the actual process time that is involved into it, how do you see the ramp-up sequence changing and the timing changing from your earlier guidances?
See, we have only given the guidance. I was there on the call last quarter, and I said that we would like it to happen as soon as possible, but it is not in our hands. So, technically speaking, everything can finish in 4 weeks time frame, but it doesn't. So, what guidance do I give you on something that I don't control?
So outer limit, can we assume that all this mine would be fully ramped up over next 2 years or so, or could it take even longer than that in terms of achieving the peak potential?
2 years is a good 2 years is a good guidance for full ramp up. That much I should be confident.
Fine, sir. And in terms of the second question was about sort of the 9.6 million ton capacity that we have. Last time, I think when we discussed, there were some gaps. So are we planning to close any gap during FY24 to improve the production level?
Surely, when we say 9.6 million ton, it starts with the metallics. Okay, so it is not all finished goods or semis or anything. It is all metallics, including sponge iron, pig iron, etc. Many of them get consumed within the system. Some of them, when we have surplus, then we are able to sell outside. Our guidance is that our company is focused on value creation, and therefore, the more we are able to value add, the better our investments pay off. So this is something that you can constantly see, that when we are saying that we made 54 heats out of a single BOF and created a world record, that is only shifting it from intermediate product to a semis level. but I don't have the finishing capacity for that semi. So today I may be selling that semi. Tomorrow when I have hot strip mill, then it immediately starts coming into production over there, and I may not have enough of semis. So this is where the sequence of investments counts a lot. And the guidance I gave last time as well was that we start from where the highest value gets created. And I did give that guidance that pellet plant is our first priority, coal mines is our second priority, and then actually the end of the chain becomes the next highest priority, which happens to be hot strip mill, because you don't create that much of value at the semi stage. So these are the kind of ways in which we are making sure that our investments are paying for themselves. I hope that is enough guidance for you.
Right, sir. Thank you.
Thank you.
Thank you. We have a next question from the line of Bhavin Chheda from Enam Holdings. Please go ahead.
Good evening, sir. Overall, a good set of numbers. So, couple of questions. One on the Australian coal subsidiary. Despite over 100% growth in dispatches, we have reported an operational EBITDA loss of 6 million. So, were there any exceptionals, or because I believe in the past we have said that overall cost is roughly around $80 to $100 to produce coking coal there. The prices are much higher. So why are we not able to report profitability at the Australian mine?
There are a couple of reasons. One is, of course, the production. The production itself, the volume is still much below the capacity that it is intended for. But more importantly, specifically for this quarter, one is there is a realization which has come down significantly. The NSR for the coal produced from Australia was $197 last quarter, and in this current quarter it is only $69. Yeah, that is number one. Number two, there were quality issues because of high ash content, which again resulted in the lower NSR. And that is the reason why you see a lower EBITDA as far as the Australian subsidiary is concerned. This is what the team over there is focusing on in terms of improving both the production, the quality, and therefore realizing higher value.
Sure. And
essentially this coal got sold as thermal coal rather than coking coal. That's the crux of it.
Okay. And any plans to ramp up volume and cost reduction efforts here, because it's been quite long when we are yet to see any cash flows or EBITDA of the Australian mine. So
if you see the quarter on quarter, there is a reduction in losses that has happened. And that is because if we were mining 3 phases, we started mining 2 phases more efficiently and got a bit of a improvement as a result of that, both in terms of cost by reducing the manpower, but more importantly also focusing on the right quality, so with lower ash content, etc. So that is a kind of an effort which is an ongoing effort right now. But yes, Australia, there have been challenges and we are overcoming those challenges as we speak.
Sure. The second one on the capital expenditure spent in the quarter and first 9 months?
In the first 9 months, the total capital expenditure.
No, I will. I think for the quarter, we just shared the numbers during my overview.
I'm also taking that out.
So during the quarter, the investment that we made into our wholly owned subsidiary, Jindal Steel Odisha, was 939 crores. And the capex that we had in Jindal Steel and Power itself, the growth and sustenance projects, was 642 crores. Totally 1,500 crores.
This is 9 months.
410 crores in Monet.
Yeah, and 410 crores in Monet. Therefore, total of 1,965 crores during the quarter.
This is during the quarter?
Yes, this is during the quarter, yes.
And 9 months figure if you have?
I'll give you the broad picture that whatever was the cash flow from operations, nearly all of it was spent on these three major buckets, which is for the power, that 410 crore capex in JSP and investment in JSO.
On the 9 months, maybe I can share the total investments into Jindal Steel Orissa was 2,708 crores. In Jindal Steel and Power JSP, it is 1,566 crores plus 410 crore for Monet.
Thank you.
Yeah.
Thank you. We have our next question from the line of Prashant Kumar Kota from MK Global. Please go ahead.
Sir, good evening and thanks for the opportunity. Sir, I have only one question. This is regarding our debt. Sir, now we have a gross debt of 10,000 crores and net debt of about, as you said, 7,200 crores something. Our EBITDA stream is now, even at this current level of, not so great EBITDA pattern, we are probably going to clock 10,000 crores per year, 8 to 10,000 crores. And the new capacity is coming up, coal mines coming up on stream over the next 2.5 years. We are sitting on a substantially cash generating asset base and asset pool. We are worried that, sir, our debt is too low compared to what our balance sheet can support. The context is that at one point we had 40,000-50,000 crores of debt. That is when we created these assets. Now those fruits are coming. So now if we are under-leveraged, maybe 2-3 years we've pushed, there's an opportunity to use our balance sheet further. I'm just thinking out loud on this. Your thoughts will be helpful over this.
First of all, you are a very good analyst. Okay, you have done. You have made our task easy. You are absolutely right. Why do you generate money in business if not for capital asset creation? So obviously, capital assets have to be created. But as you know, that we have been now changing the structure of the company in such a manner that we said that our existing investments, we will try to make sure that we move towards the zero net debt and convert this company into like a holdco and have all these entities such as JSO do the borrowing and investment on a 100% owned subsidiary model. So you are seeing that our investments are coming up, and we have also stated our position very clearly that the maximum amount of debt that we would take is 1.5 times our EBITDA. So as our EBITDA grows, our capacity to take debt will grow, but that doesn't mean that just because you have the capacity, you use it. But you have then a headroom to make ambitious plans. And those ambitious plans are always being drawn, and you keep your powder dry for any acquisition opportunity, etc. So it is important to keep the powder dry. Having an ability to invest is a more important thing than actually investing all the time. I hope that answers your question.
Sure, sir. But that answers. It would have been more happier if that 1.5 you said 3. But sure, sir, it answers the question. And thanks for the kind words.
Thank you. I said 3. No,
1.5. He's saying. So we are happy with 1.5.
Okay.
Thank you.
Thank you.
Understood, sir. Thanks, sir.
We have a next question from the line of Satyadeep Jain from Ambit. Please go ahead.
Hi, thank you for the opportunity. Just a couple of clarification questions. On the Monet Power deal, if I understood correctly, the 800 megawatt of captive power plant at the site was already sufficient for the expansion plan also. So is the power plant that is coming up, Monet Power for Angul 3, and that's given in light of the MOU you've already signed with Greenko? How does this Monet power plant fit into the entire picture, and is it basically replacing the existing captive power plant you have on site? That's the first question.
First of all, we don't have 800 megawatt of power generation capacity. It is 165 into 6. How much is that? Okay, around 800. Sorry. Yeah. So, but these are much less efficient compared to Monet Power, and our stated ambition is to decarbonize, eventually becoming a net zero emission company. But Rome was not built in a day, and you can't just jump into that future state. And it is better to have a journey where this opportunity is utilized in a very intelligent manner. And I'll give you some color to this statement so that you realize what is being done here. So first of all, 25% reduction on our power related carbon footprint immediately comes the day these assets are operated compared to the other assets. But that is not the only thing that it does. Now, a couple of other changes that have happened as a result of this is that we need process steam, and we would have spent money on investing in new boilers. Instead, we will decommission or just isolate the turbine part of it and use the boiler part of those 135 into 2 and use it for process steam. That means our capital investment will reduce significantly from there. And what also happens is that because this is a huge land in a contiguous territory, we can shorten the distance of travel for the coking coal, for the non-coking coal, the thermal coal that comes from our coal mines which are next door. In fact, the length will be 2/3 to half of its current plan, because we will also relocate our washery over there, and they already have another washery. Now, all this makes it tremendous sense from a capital allocation perspective, from carbon footprint perspective, and efficiency perspective, and we will be producing cheapest thermal power. Now, that is not contradictory to a future state where we are constantly wanting to invest in renewables and tie up renewable power capacity. We have a stated ambition to have 1 gigawatt of renewable power tied up completely. JPL, for example, is already trying to make investments into hydropower and all that, so that we are able to get green power. Our CGP-based DRI is already using hydrogen as a reductant in its process because of syngas, and we are already capable of making a hydrogen-based DRI as and when green hydrogen is available. Now, all these dots have to be connected together to be able to see the relevance of Monet Power into our larger scheme of things. I hope that satisfies you.
Yes, sir. Just a follow-up on that. When you say efficient, is the Monet power plant, does it have much better station heat rate compared to the existing power plant?
Yeah, 2,400 as against 3,000.
Okay. Just another Australian coal mine, you said it is being sold and the NSR is very low. If I'm understanding it correctly, historically the idea was that the coking coal from that mine will be exported and used in the JSPL steel plant. Is that mine selling coal somewhere else as thermal coal?
See, first of all, I think you're on third question rather than second, but it's okay. Australia, I think we have to get our act better, and we are working in that direction. Currently, this coal has so much of ash content without having a washery that we are having to sell it more like a thermal coal. We are not getting the coking coal prices for this. Of course, we are in negotiation and discussion with parties that have got washing capacity and are hungry for coal of this nature so that they can get the right coking coal. And we would like to sell coking coal asset from a coking coal rather than thermal coal. So all this is an improvement on which we are working, but obviously we are not where we should have been.
And maybe if I can add this, see, I think the choice of whether it is going to be consumed captively or sold externally, I think that will be made on a dynamic basis. So for example, in the second quarter, 100% of it was consumed captively. Whereas in the third quarter, because of the quality related issues, we had to make those choices. So I think that's how it will be on a dynamic basis.
Okay, thank you so much.
Thank you. We have our next question from the line of Ritesh Shah from Investec. Please go ahead.
Hi, sir. Can you just update us on the capex plans? You have indicated around 18,000 crores. I presume that is, it does not take into account the mining capex. So if you can just help us with some numbers, what we should bake in for full year FY23, 24 and 25. 1 quarter for this year and 24, 25, please.
So we will, first of all, that number was not 18,000 crores. I think it is 22,000 crores. 24. Including Monet, it is 24,000 crores. So that is a number that you would like to keep in mind. It is that number and not, I think you might have numbers without GST or something like that. So just kindly make that correction with yourself.
Sure, sir.
Okay. And as far as mining assets are concerned, obviously, we will have to get back to you with the full assessment of our mining plans.
We are making we are kind of, we are finalizing the entire slate of capex over the next few years, and then maybe over the next quarter or so, we would be in a position to share more clearer numbers, Ritesh.
Sure, sir. And sir, I just the question that I just had to follow up on the prior questions which I asked. The one more specifically on Botswana, you indicated JPL is doing something. We don't have much to say. I just wanted to check. We have a coal mine, I think, under JSPL, which is in Botswana. Will it have anything to do with if at all a power plant comes under JPL over there? I'm just trying to have some sense from a related party transactions going forward.
Yes, we will be the beneficiary. They don't have any other source of coal.
Okay. But sir, then the current write-off that we took, I think you indicated that it also included the regions of Bolivia and Botswana. So I'm just trying to connect the dots again over here, just trying to understand the rationale. If the impact to be done, then why are we doing it now? If there is some hope at a JPL to put up a power plant and do something with the coal mine over there.
So maybe you'll have to look at it in two ways. First is this JPL, when the power plant will come, etc., is a bit unknown to us. Yeah, I don't think it is a immediate short term to medium term. It is going to be operational. I mean, we don't have all the details, but that is number one. Number two is in terms of the provision that we have taken. That is an assessment, best case assessment based on what we see now. Yeah. Now, if conditions change, if things improve, if we see better value available at a later point of time, then we'll have to relook at it at that point of time. Again, in this provisions, we have considered two things. One is the net present value of the inflows, and also we would have considered a terminal value of the reserves that are there. So I think that is how the value of the assets would be made. So the terminal value of some of these assets have been considered appropriately.
Sure, sir. Sir, can I squeeze in one question? I think it's important for investors as well. Looking at the history of the company, we have seen first it was Oman, then it was JPL. We divested it for the right reasons. It ended up in the folds of the promoters at the right costing, right valuation. That's perfectly fine. Sir, how would we be able to give some assurance that something of that sort, probably, say if I look at the Botswana coal mine, or if I look at the Australian assets, we have taken a right back, and if I go back in history, I think same things actually played out for the other assets in past as well. So will we look at a hive-off over there, divested? It's a hypothetical question, but I think if you can give some color over here, some assurance, I think that would be good.
So first of all, you have yourself said that at the right value something has been done, and if today JSP is having a strong balance sheet, it is thanks to some of these divestments. Otherwise, from a 46,800 crores level of gross debt, we wouldn't have been at 10,000 odd crores of gross debt if some of these divestments wouldn't have been made. So why would somebody be looking for assurances, etc., if there is such a positive story to talk about? And in any case, the second point is forward-looking statements we refrain from. And you are asking for an assurance on something that we don't even know that it is an assurance, or what is your fear? Because as far as the history is concerned, the company has done well by making divestments.
Right. Sir, the fear is basically JPL was divested, citing ESG an example, and we are looking at Monet assets right now, citing the rationale of say station heat rate and logistics. So I'm just trying to again just connect the dots. So that's why I use the word assurance. So at the right price, it's fine. But then the rationale that we had cited earlier and what we are citing right now, I think if you look at in the history of the company, I'm just not able to connect the dots again.
No, but we have given very, very clear rationale and logic for Monet acquisition. And if so, I don't know if I can save something today. Why will I not do it? And should I allow somebody else to take a large piece of land right next door, which is actually literally going for a song? You know how much is the money, time, energy that is to be spent in acquiring additional land. Even if there was no power plant over there, that land should have been acquired at that price and it would have been still worth it. That is the kind of a valuation that we did. It is a completely different matter that it has got a half-finished power plant, which happens to be extremely efficient. And therefore, that asset, acquiring that asset made so much of a no-brainer sense that the first time I visited it, after I became the MD of this company, it was not even on the horizon, but I started saying that this asset must be acquired. Without any consideration to what we have done to JPL, etc., or what the market would think. Because this is the most logical thing to do with such a huge area under a clear title ownership with a boundary wall contiguous to our own plant. It made so much sense that even if we had any history of power plant or not, we should have acquired it. Even if we had to dismantle that power plant.
Sure, sir. I have follow-up questions. Probably I'll speak with you separately, sir. Thank you so much. Thanks.
Thank you. We have a next question from the line of Kirtan Mehta from BOB Capital Markets. Please go ahead.
Thank you, sir, for giving me another opportunity. Just one follow-up question.
Mr. Mehta, you're not audible.
Is this better now?
Yes.
Yeah. Thanks for giving me one more opportunity. Just in terms of the asset write-off for the JSPML, we have done it 7,000 crore. Could you give us sort of the asset value as well as the capital structure under that subsidiary, and how much loans are existing, and whether the capital structure is sufficient to take care of it?
Some of this is already externally available information. You can access it in our previous annual reports. Or if you have further questions, our IR team can share you the details. This is all publicly available information.
In the interest of time, this was the last question. So, would like to conclude?
Yes, sir. I would now like to hand the call over to Mr. Pallav Agarwal. Please go ahead, sir.
Yeah, thank you. I would like to thank the management of JSP for giving us the opportunity to host the call. And also, Mr. Jha, any closing remarks from your end?
I think it will be helpful probably to look at the results from a dispassionate perspective. Some of the analysts have already taken the right view on these results. I have always maintained that profit is an opinion and cash is the reality. And if you look at cash position, the company has done well. If you look at the investments, it has made the right kind of investments. It has made right calls. I think much has been unnecessarily been an angst among some of the investors about this acquisition of Monet Power, particularly thanks to the JPL divestment. It didn't make sense. but I guess we have been able to give a cogent, consistent reply around the subject, both from a decarbonization perspective as well as from the strategic perspective of this land, which lies right next to us. What we realized in the course of due diligence was that there were so many more pluses that it was completely a no-brainer to make this acquisition for many other reasons, leave alone the power plant. So I think everybody would be hopefully convinced. If anybody wants to come and pay a visit to that area, we would welcome you very much, because then what I see, you will be able to see. And I would only say that keep trusting your company for the kind of decisions that we are making. At the moment, we are the strongest balance sheet company in India compared to any other steel company. We are also completely focused on infrastructure and construction, which is the thrust area for the government. So even at 6.6% GDP growth rate, normally you would expect a steel intensity of that growth rate to take you to 8.5% increase in steel demand. But we have seen the first 9 months of the year at 12% increase in steel demand, and most of it is from infrastructure and construction. The fact that JSPL portfolio is completely focused on infrastructure and construction, you should feel more and more confident about the company and its policies. Thank you very much. Hope to see you next quarter with similar kind of results. Thank you.
Thank you. On behalf of Antique Stock Broking, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
The conference is no longer being recorded.